Hello, everyone. Welcome to the NT Trading. Indian stock markets have faced continued downward pressure, marking the fourth consecutive session of losses. The BSE Sensex slipped marginally by 16.82 points, or 0.02%, closing at 80,065.16, while the Nifty 50 fell by 29.80 points, or 0.15%, to settle at 24,405.70. This persistent decline can be attributed to several key factors that have significantly impacted investor sentiment. A primary factor behind this market downturn has been the sustained outflow of foreign investments. For the 18th consecutive session, foreign institutional investors, FIs, have sold Indian shares, largely driven by elevated valuations in India compared to the relatively cheaper valuations in markets such as China and Hong Kong. This shift in focus has been prompted by Beijing's recent stimulus measures, which have made China's stocks more appealing to global investors. The net selling by FIs continues to weigh heavily on Indian equity markets, contributing to the overall negative sentiment. Another significant factor that contributed to this decline was disappointing corporate earnings. Hindustan Unilever, one of the major players in the consumer goods sector, posted a quarterly profit that fell short of market expectations. The slowdown in urban demand, coupled with higher costs, has hurt the company's performance, causing its shares to tumble by 5.8%. This marked its worst session in 9 months and added to the woes of the fast-moving consumer goods (FMCG) sector, which saw a sharp decline of 2.8%, making it the top sectoral loser by percentage. The Nifty 50 has now lost around 2% for the week and is down by a substantial 7.15% since hitting a record high on September 27th. Rich valuations, coupled with lackluster earnings, have contributed to this market correction, leaving investors cautious and uncertain about the near-term outlook. The continuous foreign outflows, combined with weak corporate earnings, particularly in the consumer sector, have made it challenging for the market to recover from its recent lows. However, not all indicators point to a slowdown. Despite the challenging market conditions, India's private sector economy continues to expand. The HSBC Flash Purchasing Managers Index (PMI) survey, compiled by S&P Global, revealed that the India Composite Output PMI Index, which covers both the manufacturing and services sectors, reached 58.6 in October, rising from 58.3 in the previous month. This is a positive sign, indicating sustained growth in the private sector, well above the long-term average of 54.7. The ongoing correction in Indian markets is not isolated, as other Asian markets have also faced similar declines. The broader region saw losses, tracking a drop in Wall Street, where investors hesitated to make significant moves ahead of the upcoming U.S. presidential election. This global uncertainty, coupled with rising U.S. bond yields and concerns about future Federal Reserve policies, has contributed to a more cautious investor approach across global markets. In terms of sectoral performance, it is noteworthy that 6 out of the 14 major sectors in the Indian market recorded losses. While financials and IT managed to hold their ground earlier in the session, they too faced pressure as the day progressed. The broader market sentiment remains weak, and the lack of major positive triggers has made it difficult for sectors to show any sustained recovery. While the global and domestic markets face headwinds, there are some bright spots on the horizon. India's macroeconomic stability remains intact, and with the right policy measures, there is potential for a rebound. However, in the short term, market participants must navigate the challenges posed by weak earnings, foreign outflows, and external geopolitical risks. In conclusion, the current downturn in Indian equity markets highlights the impact of global investor sentiment, corporate performance, and macroeconomic factors. While the market faces challenges from sustained foreign outflows and disappointing earnings reports, the resilience shown by the private sector's growth is a positive sign for the future. As the markets continue to react to both global and domestic developments, it is crucial for investors to remain informed and vigilant in navigating these uncertain times.
This video is made for educational purposes only. Please don't make any investment decisions based on it. If you like the video, please like, share, and subscribe. Thank you.